We are excited to be here with you guys. We've got a bunch of you on, and so we're going to dive in. And thank you so much for joining us. First of all, thanks for joining from wherever you may be joining all across the country. As I saw the registrations come on this webinar, I saw so many names who I love and appreciate so much. And I know you're all over the place. And we really wanted to get together today. There's a couple things that we want to share with you. And so the first thing, we've been getting so many questions from so many people on what is going on in the market, what is happening right now. And really that question, I think the sub question there is it a good time to buy? Should I be buying? Should I be sidelined and waiting? What exactly is happening? Now, I don't know if some of you have had some of those thoughts and feelings as well, but we thought we could jump on today and talk a little bit about specifically what are we seeing in the mortgage industry? What are we seeing just in the market? Is it a good time to buy? And if it is a good time to buy, what makes it a good time to buy, considering that the conditions of the market right now are so different than they've been the last couple of years? And then we are going to be announcing officially. Now, we did a podcast, oh gosh, I don't know, a month or so ago, where we sort of like whisper campaign announced that we are open in a new market, but we have not done a real like a webinar or a massive announcement. And so we wanted to do that today. And that's why we've got Tyler and Preston on with us, which is going to be great. And do you guys know, is Gary going to be able to join us too? Do you know, is he able to get in?
He's a viewer right now. I think he needs to be upgraded to a panelist.
Okay. Oh, got it. Okay. Thank you so much. I'll go do that. Steve, I'm going to turn the time over to you. Let's kick this thing off and let's just start talking about what we're seeing in the market right now and why we feel like now is literally maybe the best time to buy in history.
Well, it's really interesting, and I'm super glad to be here, and welcome everybody for who's on the call here today. It's really interesting. If you were to listen to CNN or Fox News or MSNBC or just your local radio for that matter, you would think, again, the sky is falling. You'd think that, things are terrible for investing in real estate. There are some crazy things going on in the economy, and that's for sure. There's no doubt about that. And so there's a lot of concern. There's a lot of question. And so a lot of people is kind of like, well, I'm just going to wait until this happens or that happens. One of the first questions we always get, or one of the first concerns that people have, is it's like interest rates are so high right now. Like interest rates are just crazy, and I'm going to address that. I'm just going to identify a couple of things real quick, Kevin. But interest rates, and people are also hearing that home values are going down. We'll address that. There's the idea that there's no demand for properties right now. We'll address that. And so the first thing that's really interesting, to me, is it's like, oh, interest rates are so high. It's just crazy. It's too high to be buying right now. So the reality is what's really abnormal is 2 and 3% interest rates. That's abnormal. What is normal is 6 to 8% interest rates. If you look at things historically, over the course of decades, interest rates historically have fallen between 6 and 8%. There were times, in the 80s when they bumped up as high as like 18%. We'll talk about that in just a minute. But the reality is that interest rates are normal. And Kev, we've been doing this a long time. We've been doing this about 15 years, right? And I don't know if you remember what interest rates were back in the day when we first got started, 15-ish years ago, but they were in, the 7-ish% interest rate. And it was a great time to be buying back then. And the reality is the way that we buy real estate, interest rates today are perfect. They're normal. Cash flows are a little bit lower, and we'll address that a little bit. But here's the thing: is with a little bit higher interest rate on, our average purchase price is about $285,000 across the various markets that we're in. And when you put 25% down, your mortgage payment will be X. At an interest rate of like 5.5% versus 7.25%, the difference is about $200 to $250 per month. And so when you look at that over the course of, say, 3 years, you would be paying you'd be losing out on about $7,500 in cash flow, right, over the course of about 3 years. But let's take a look at some of the other elements of when you buy single family homes. There are 4 areas that we like to focus on. The first one is cash flow. That it's an important one. We don't want to belittle it at all. But of the 4, it's probably the least of all. Then the next thing that you have is you have principal pay down. Every month you have a tenant who is paying rent. Is paying rent, and that is paying for your mortgage. And every month there's principal pay down. And on that size of a loan, that principal pay down is anywhere from $150 to $250. And so that's right there alone. That negates right there the loss on the $7,500 that you might have had during those 3 years, right? And so there's the principal pay down. The next thing that you get with single family homes is the tax benefit of depreciation. And depreciation is another, $200-ish a month that you get to write off. It's real dollars that you don't have to pay in taxes on an annual basis. And so now you're up $7,500, and then you have appreciation. And that's another, concern that some of our clients have expressed, or prospective clients have expressed, is it's like, oh man, like here in Utah, the market is down about 10%. And so kind of the natural thing to think would be everywhere is down 10%. But the reality is, in the markets where we buy, which include 7 markets now, and we'll go through those markets now prior to making, our big announcement of where we've just, well, I guess everybody knows where we just opened up, but we're up in those markets anywhere from 3 to 6.5% this last year. And so in the markets where we buy, we're up. And the reason why we're up in those markets is because we very carefully selected those markets based on the demographics, the population growth, job growth, companies coming into the areas, plans for companies to come into the areas and build manufacturing plants and that kind of a thing. And so we look at all of these different factors. And so there's one additional reason why I really feel like in today's world, it's one of the best times in the history of the country to be investing in real estate. Is number one, the market is very normal. Normal is very predictable. And you win every time with normal when you're buying single family homes the way that we do here at Done for Your Real Estate. And so here's one of the other factors. A year and a half ago, for the last couple of years, up until about mid-year last year, there was blood in the water. So every time you put an offer on a property, you had 10, sometimes 20 people bidding on a property. We had to prepare our clients who were in the process of buying properties to understand this fact, and the fact that the purchase price would be bid up and it would go above appraised value. And so even though it was a fantastic time to be buying because interest rates were so low, everybody was having to pay a little bit above asking price, anywhere from $5,000 to even sometimes $20,000 above asking. And it was still a good opportunity to buy even at that rate. And one of the reasons is because things were appreciating in double digits everywhere. And so there was this short-term gain that was going on. And quite frankly, like, it was good for the small percentage of individuals like ourselves and everybody on this call who are real estate investors, but it was very unhealthy for our economy. Think about our kids and our children and the up and coming generation and their inability to buy properties now because things rose so quickly that wages did not keep up. And so from that standpoint, it was unhealthy. It was kind of exciting, but here was the downfall, is that all of us who bought homes during that time, and I was one of them, is that we had to pay above asking price. Now, in today's market, we get all of this normal that's going on. And in addition, we can actually make an offer on a property, and we're the only offer on the property. And so let's say there's a home that's selling for, $280,000. We could offer like $272,000, and we end up getting it for $275,000. That's kind of the norm right now, where we get it, the homes for a little bit below asking, in many cases, or kind of almost worst case scenarios at asking price. That's normal, and normal works fantastically well. And so, we've had a couple of conversations with clients recently, and it's one of the things that kind of spurred this webinar that we wanted to have, One of our coaches was having a conversation with a client here just a week or two ago, and they were very concerned about the market. And the coach Adam, he asked a couple of questions. Well, tell me what your concerns are. And it was all the things that I talked about: interest rate, appreciation or depreciation, low cash flow, and some different things. And when he had this conversation with him, it was really interesting. What happened is, like, all of a sudden it's like, wait a minute, now I'm seeing things from a little bit different perspective, maybe a perspective that's not so broad and so general, which is the perspective that we're given on the news media, that when you buy right and you buy in the right markets, like, there literally probably hasn't been a better time because of everything that I just talked about. And one of the greatest things is the predictability of what you're able to purchase right now. Now, one of the other things, Kev, and interrupt me anytime, but one of the other things that I want to just address as well and just bring up is that in the market today, even before COVID, there was massive pent-up demand. So we're living in a world, like, just go to economics 101, simple supply and demand. Years ago, pre-COVID, we knew that there was massive pent-up demand. Builders had not been building for years and years, and the rising generation was beginning to buy. And so there began to be a little bit more demand. We could see some of that. And when COVID hit, again, the general news media was saying, oh, prices are going to fall, the real estate world's going to fall apart. We're kind of like, well, hold on. Like, we don't think that's the case because of some of the simple economics. Back then, there were millions and millions of individuals who needed to buy properties that were not available. And with COVID, that everything got exacerbated because we couldn't get supplies, and supplies, for that reason, wood and, lumber and windows and concrete and drywall and everything that you needed to build a home was on back order because there was so much demand, and things couldn't get, supplied across the world. Nothing has changed today. We did not build enough homes to meet that demand. That demand has stopped. And the reason why that demand has stopped is because interest rates have been raised just enough to put out of reach the opportunity for the millennials and Gen Y and Z to begin buying properties, because they're in that position where they're beginning to buy now. They're just barely out of reach. I don't know if it was intentional or not. I'm not a conspiracy guy, but the reality is it's just out of reach by literally hundreds of dollars. And so there's this massive pent-up demand right now in our country, and everybody's on pause, right, to buy a property. And so there's this massive pent-up demand because interest rates are 7.25%, 7.5% for investors, and for single or for primary buyers, it's in the high sixes for the most part. And so the minute interest rates drop to that rate where it's like all of a sudden, okay, it's down, like my payment's going to be a few $100s less, I can buy that home now. The minute that happens, we're not going to be in a situation anymore where, as investors, we can kind of take our pick of the best properties out there, where we can maybe even get a little bit of a discount on the property. That will go away. The pent-up demand is massive. Just read an article confirming it again the other day. It's in the millions. This article I've read, you see different numbers, right? Anywhere from 2 to 4 million. And I've read one that was 5 million. But it's in the millions of homes that need to be built where there is a lack of supply for the people who need and want to buy homes. And so right now, we've got kind of this pause going on. We have this opportunity. And as you know, Kevin, because of that, I mean, you and I personally, as owners of this company, I think we completed our 6th purchase this year, you and I in partnership, because of the opportunity to be buying. And so it's an exciting time, and we just wanted to get that message out initially. So I want to kind of open it up to you, Kev, to you, Mike. I know Mike is like a deep dive number guy. He might be chomping at the bit to provide some additional statistics on some of the things that I shared. Kev, any additional thoughts or commentary to what I've shared here?
Yeah, sure. And so I'm just going to read a comment that we got too. Brett said, interest is up, but home prices have not come down. In some markets, there's 20 plus offers going on homes. In Atlanta, he said, my daughter made a $415,000 offer on a home listing of $400,000. After 10 plus offers, it went for 50 above asking. So what you're talking about, Brett, is you're talking about this fact that there is still this pent up demand. And so you may find the right home or the right market where there is still some of that that's taking place. You look at the markets that we're in right now, and you look at the home level of pricing, where we're right around 285,000. We're just telling you what we're seeing kind of across the board, that we're able to go and put an offer in that's at or slightly below asking price, and we're able to win those. So that's just kind of a comment there. The other thing I wanted to mention, Steve, is you touched on it, but from an interest rate standpoint. So I was at a barbecue in our neighborhood, and I was talking to this awesome couple. They're good friends of ours. And they are, I don't know if they're Gen Y or Z, because I don't really know where the letters start and stop, but they're one of those gens, right? They are like in their 30s. They've got kids. They would love to go and buy a primary residence, and they are in a position where they should be able to, but it is just barely out of reach. And the main reason they mention it, they have a little bit of money for a down payment. All they're looking for is the kind of 3-bed, 2-bath kind of home that we do, but they're in Utah. But what they said is the problem is what their mortgage payment would be given interest rates being what they are on a primary residence that they're putting a small down payment on. It's just unrealistic for them. Now, what's interesting about that is they're not the only ones, right? You look at all of these markets across the country. If interest rates are higher, people are sort of worried about it. So the Fed just raised interest rates again. We've seen that reflected in mortgage rates. Mortgage rates, they are quite literally where they were when we started this company. And what was interesting, and I was thinking about this, Steve, because I was doing the loans for the company back when we first started. I don't know that I ever had a conversation with people about interest rate, right? It was mentioned, we were talking about it. Nobody was holding off because of interest rate, because that was the environment. We all got massively spoiled with 2 and 3% interest rates. They are not coming back. They are not coming back anytime soon. Will they come down? Look, we don't know, but the reality is they probably are going to come down some. But here's the key. If we wait until those interest rates get back into the high 6s or the mid 6s or the high 5s, what is going to happen to people like my friends and everybody else that is in that pent-up demand on the sidelines? They are going to flood the market, which is going to continue to drive prices up. And as a result, I want to be on the owning side so that when I own that real estate and the interest rates do come down potentially a little and everybody decides to get back in the market, everybody's going to re-enter the market either because interest rates are where they feel like they can comfortably move forward, or they're going to be sidelined long enough to realize the market's not really changing much and now they're jumping in. Either way, as that demand continues to increase, I'd rather be on the owning side where I can take advantage of some of that equity increase. The other thing that I wanted to mention that's really interesting, because we've had people, and you guys know because we've had conversations, we've had a lot of people that have kind of wondered, well, okay, is there an impending crash? Look, we don't have a crystal ball, but here's what I could tell you. If you look at why it crashed before, okay, so if we talk about like the Great Recession, there was massive foreclosures. Mortgage defaults are lower now than they've been over the last 23 years. I was looking at an article this morning, and in May was the lowest mortgage default percentage rate among those that have mortgages than it's been since like year 2000. So now here's what that tells me. If people are not defaulting on their mortgages, there's not going to be massive foreclosure. There's not going to be a massive sort of, I don't know, what's where I'm looking for, windfall, I guess, of homes that are coming onto the market, which will drive prices down. So I look at that. I look at demand. I look at the interest rates are relatively normal. And I look at everything you mentioned, Steve, that even if I'd rather own today and get the benefit of appreciation, get the benefit of the tax advantages, get the benefit of the principal pay down, even if my cash flow is somewhat diminished. And, we had a conversation yesterday, Steve. I told you I've been watching this. Has anybody else been watching the Netflix series called Quarterback? I don't know if anybody has seen it's awesome, right? It's awesome. It follows Patrick Mahomes, and it follows the Kirk Cousins, the Vikings quarterback, but it's really interesting because you get to see kind of some behind the scenes of sort of what goes into these game plans. And Steve, you and I were talking yesterday, and we were kind of talking about the analogy. I think as real estate investors, sometimes we have a tendency to look at the cash flow month one, and if it's not where we want it to be, we judge the entire investment as a result of it. And Steve, you and I were talking about after me having watched that quarterback show, that would be like one of these head coaches judging the entire ability for their team to make the Super Bowl based on one run play that takes a loss. right? So example, if all you're looking at in isolation, you hand that ball off and your running back loses 3 yards and you decide that whether or not your team is going to make the Super Bowl, that's kind of what we're doing sometimes with cash flow, but it was so important for so long. And we talked about it a ton that I think it's hard for us to kind of adjust our mindset to realize there is so much benefit from owning real estate right now and in the future that even if cash flow is diminished a little bit, we shouldn't be judging the entire investment based off whatever that number is today. We're still seeing positive cash flow. It's just less than it used to be, right? So I just kind of wanted to mention that. Those were some of the thoughts that I was having as you were talking. Mike, anything you want to add to that with your Rain Man-like wisdom?
Thanks. I think, yeah. Hey, can I get the share screen access?
Oh yeah, sure.
Yeah, great.
Let me get you that.
I do think it's time, understandable for investors to take time and want to understand the environment that we're in now, understand the risks that are there, and of course that there's risk of action and risk of inaction. But just know what they're choosing. I always like it. If you start right, it's easy to stay right. If you start wrong, you have a hard time going right. I like to help investors enter the purchase with the perspective that this, of course, is not a short-term investment. Warren Buffett said, if you're not going to own a stock for 10 years, you shouldn't think about it for 10 minutes. Stock is another kind of ownership investment. Of course, real estate is a ownership investment. And ownership investments sometimes don't work out well in the short run, but a diversified stock portfolio and real estate, of course, has always worked out well in the long run. And so it makes sense to look at what we're at and make sure that you're looking at this as the long-term investment that it is. And when you do that, there's a couple things that relate to what you guys talked about. So first of all, home prices. We can't tell you exactly what's going to happen now. What we can tell you is that there are over 50% of the US counties right now where there are more people moving out of than into. And of course, we're not helping our clients invest in those markets. We're always looking at the big macroeconomic factors to try to determine whether it's the right time to stay in a market or expand to another market. And so the markets that we're helping our clients invest in are the markets you see over here on the eastern part of the United States. They're the markets where there are more people moving into than out of, literally between 3 and 5 times as many people, 3 to 5 times, not percent, but times population growth in the markets that we're helping people move to, because they're markets where there's blue skies, there's no state income tax in a few of them, there's strong economies, first and foremost, most important. And that population growth is so key. And so it is a time to be cognizant of where you're investing. Western United States doesn't look as attractive. If you look at this map here, this is from peak to trough during this last pullback that we're still in parts of the country. Steve mentioned here in Utah, we've been down 10%. In California, Bay Area, they've been down 20%. There's areas where it has not worked out well if you just look at peak to trough here, or if you give it a full year, it's not quite as many areas that have gone down in value, home prices. But if you just give it 3 years, and Warren Buffett said, don't invest in stock if you're not going to give it 10, we tweak it and we say that this kind of conservative real estate investing, if you don't give it 5 to 10 minutes, if you don't give it 5 to 10 years to do its job, then don't think about it for 5 to 10 minutes. So here's what it's looked like to own real estate in their home values over just the last 3 years. So if you've heard the study of a blindfolded monkey throwing darts at the wall to pick stocks that outperform the experts, literally give it time, and real estate just works out. Of course, we want to help it work out better than just average, or better than what you might have done without our help. And so that's why we go to those areas where there's growth and demand and better than average appreciation. And some of the things that are on investors' minds that Steve talked to, inflation this last year averaged 8%. We've had times in the last 50 plus years where it was higher, times when it was lower. But of course, that's started to come down. Mortgage rates are not out of the historic average. They are a lot higher than people are used to the last couple of decades, but not higher than what they've averaged the last 5 decades. And home prices not going up in a straight line, but a pretty consistent track record of going up over time. And the beautiful thing about real estate is, because there's so many ways that an investor can benefit from it. an investor technically is not paying that extra interest that we're all having to pay right now because interest rates are higher than we were used to over the last several years. It's of course the tenant that's making that mortgage payment, paying that interest payment for them. And so as you look at, that's just one example of the multiple ways that an investor benefits from real estate: appreciation, tax benefits, principal pay down, and leverage is so powerful, what that can translate for somebody over time. And so if an investor can keep those kind of things in mind, and also realize that even though home prices will go up and down in the short run, you have a long track record of rents being historically either up or flat. During the worst downturn in any of our lives, the Great Recession, rents across the nation as a whole went flat, not down. Areas of the country, they went down, but not across the nation as a whole, and not, of course, in areas where there's more people moving to than their homes available for them to purchase. So it's just a matter of having that long-term perspective. I think that it's so important for an investor to either get started now, because that's the name of the game. You got to get started for this to work eventually for you, or to take the next step. And that's obviously some stuff that we want to hope make sense of. And we've updated our property analysis, if you haven't seen it yet, to focus on some of these things that Steve was talking about, to look at that total return and what it can do for an investor. And we'll come back a little bit later. Maybe this is an example of a property in the Dallas-Fort Worth area. We'll come back and talk a little bit more about that later. But yeah, thanks for letting me share a little bit there.
No, that's great. Thank you, Mike. And just one last comment, and then I want to transition, and we're going to talk to Gary and Tyler and Preston. So one of the things that I've just been, it's been on my mind that I've been thinking about is, we always know that when we react fearfully, there's not always a positive impact. That being fearful is sort of different than being cautious. And Mike made a really good point. Even with these higher interest rates, we're not necessarily the ones paying them, right? Our cash flow maybe has been diminished, but it is our tenants that are paying those interest rates. I think that we don't often look enough at opportunity cost. If I were to hold off buying a property, and this is why Steve and I have bought so many properties this year, if we were to hold off because of the fear in the market or what we don't know is going to happen, if we just look at some of the things you're going to hear from Gary here in just a second, if you look at what we believe is coming down the line, just from basic economic principles, right? And what Mike just shared, some of these areas that are growing and where people are moving from and going to, with the pent-up demand, with the fact that people are not buying because interest rates are a little bit higher, even primary residence owners. Personally, it would be costing me thousands, if not tens of thousands of dollars a year for every year that I choose to wait. And I could break that down. It could literally be costing thousands a month for every month that I choose not to take action if I'm sitting on the sideline waiting for the perfect, what I perceive to be the perfect real estate storm. So we just kind of want everybody to feel that and know that.
Do you want me to walk through those numbers really quick?
Yeah, would you? Yeah, why don't you do that? See, because I think it's so fascinating. And then let's transition over to the newish market. I say newish because if you've been listening to the podcast, we're in Texas, and we're going to talk about Texas in a second. But yes, go through those numbers real quick.
Yeah, just super high level. Okay, these are super high level numbers. This will drive Mike crazy because he likes to go to the sixth decimal place typically. So I'm going to go super high level. So there really is an opportunity cost to be making a decision just based on cash flow, because that's one of the biggest hurdles. I don't like I said, I don't want to diminish the importance of cash flow, but in the bigger scheme of things, over the course of just 3 years, the opportunity cost is nearly $50,000. So let's take a property, a $300,000 home, okay, just to make the numbers real simple. If I were to buy this home at a 5% interest rate, 25% down, my cash flow is going to be, I'm just going to use a number called X. If I buy the same home at 7.25% interest, my mortgage payment is going to be X, right? And we're going to call that number about a difference of about $200 per month in cash flow. Okay. So let's say that at 5%, my cash flow was going to be $300 a month, $350 a month. And at the 7.25% interest rate, I'm going to, my cash flow is going to be $100 per month. Okay. So there's a delta of $200. So if I choose not to buy, because literally I'm losing out on $200 per month cash flow, I'm making a decision not to buy this home because of that $200 per month less cash flow. Because over the course of 3 years, I mean, it's a substantial amount of money. I'm going to lose out on about $7,500. Okay. So number one, so you are still getting that $100 per month. So that would be $3,600. You take the 7,500 minus the 3,600. Now you're still down about $3,600. And Mike, you might want to have your calculator ready to go to help me with some of these numbers in your brain. Okay. So number one, but what is not affected by interest rates is, for the most part, principal pay down. And let's call that, for easy numbers, $150. Just be conservative. Let's call it $150 per month times 3 years. That is 1,500.
5,400.
It's about 5,400. So now we were still down 3,600. We're up now 5,400 minus the 3,600. That's about $2,000, about $1,800. Okay. So now we're up $1,800 just for the principal pay down. Now we got depreciation, which is another $200. So add the times 3, call it, just to round up, $7,500. So now we're up the 1,800 plus 75. Now we're up 85. We're up about $9,500. Now let's add in appreciation, and let's take a conservative 3.5% on a $300,000 home. That's about $10,000 per year. So that's about $30,000 plus the $10,000. That's about $40,000 right there. So our opportunity cost for sitting on the sidelines is about $40,000 because we got a little bit myopic in our vision, and we made a decision just based on today's cash flow of that number. Now, I want to point out really quick, and then I'll get back to my numbers, is the property analysis that Kevin or that Mike kind of showed you. We now show you a bigger picture. We show you, instead of just looking at that first running play, right? Which is, thanks, Mike. The running play that Kevin described, where like you don't want to make a decision on anything in buying real estate based on first month's rent of $100. That's like that first running play that you basically get to the line of scrimmage, and you make the decision not to finish the game or to play the game because based on that one run. We look at these bigger numbers. If you look at this PA, we take a look at what the average cash flow will be over the course of the 10 years. And so even if the first month was, and on this PA, in fact, it shows $115 per month in year one. Well, if you take a look at the 10-year average, it's actually almost $300 per month. I mean, if you looked at that average, it's like, hey, the average cash flow on this home is going to be about $300 per month. That's pretty good cash flow. And so looking at the numbers that I just shared with you, there's $40,000 of lost opportunity costs. Now I'm going to add one more in there. This is a little bit more speculative in nature, but it's this, and it's to Kevin's point, the supply and demand. The moment interest rates go down, let's say 3 years from now, interest rates are somewhere in the mid to low sixes even. There's going to be significantly more demand. And the property that you might have been able to get for a discount of say $5,000 is you're now having to pay asking price for it. Well, there's $5,000. And if there's a lot of demand, like this gentleman from Atlanta who shared this property in this particular market, it got bid up. There is that chance it could get bid up a little bit more. Let's call it gets bid up $5,000. There's $10,000 right there potentially. If you waited to buy the same home 3 years later, you're gonna have to pay even a little bit more than that $30,000 in appreciation, and there's your $50,000 delta for having sat on the sidelines. And so I'm pretty passionate about this because I think back, you guys, many of you bought properties back during the Great Recession. I'm positive we have a lot of you on this call today that did that. Do you guys know that I helped hundreds of people buy thousands of properties back then? Do you know how many I personally bought back then? I bought 0. Like prior to that, I'd bought a lot of real estate, but in the moment, I was so wrapped up in running the company and helping our clients and doing what we were doing, that I got blinders on. And today I wish I would have bought, 10 of them. I wish I wish I could have bought 100 of them, right? I wish I would have bought one of them, and I didn't. And when I looked back and I saw what I missed out on, I was like, how did I do that? Like, I was in the middle of this thing. I could not see the forest through the trees, right? I was in that state. And so I look back and I promised myself that I was never going to do that again. And so for many years now, I've been buying properties on a regular basis, on an annual basis, despite what the market's been doing. I was buying before COVID. I bought during COVID. I've purchased post COVID. With Kevin, we purchased 6 homes in 2023. And it's because of kind of that concept, but it's also I am just jazzed about being in this market where, I bought a number of homes when I had to bid against 10 people, and I had to pay more money than the asking price, and all of these different things. And so I've been so excited to be able to get a property for a little bit below asking price, to have a little bit, more opportunity. The inventory is a little bit greater than it was back then. And so that's kind of my mindset. And I just want to translate that to our clients, that, my hope is that you don't look back, 3-5 years from now. It's like, I remember that webinar that these guys did. Dang it. It's like, I should have bought. And we get that all the time, and it's okay. It's an ongoing thing. We all go through it. But I'm hopeful that those who are on this call today will think a second time about taking a very close look at the opportunity that you have today to buy. So having said that, if there are no other questions, Kev, do you want to roll into our new market with Gary and Preston and Tyler?
No, thanks, Steve. I echo everything you said. Is awesome. So if you guys have been listening to the podcast, Replace Your Income, you maybe know, because we did a podcast with Gary. If you're not listening to Replace Your Income, the podcast, why not? It's awesome. But that's about the only place that we kind of if you went to the website and you look for properties, or if you've signed up for the Daily Fastball, and if you are not on the Daily Fastball, go to dailyfastball.com and sign up. We are texting properties almost every day, properties that are purchasable, but you can see actual property analysis every single day on a property across all the markets. If you've been watching that, you've seen that there's been some Texas stuff coming along, but we didn't really have a coming out party for Texas. And so we wanted to do that today because we are open in Texas, thanks to Gary, thanks to Preston, thanks to Tyler. And so Gary, I wanted you to talk a little bit about, you were in my office yesterday. We were just talking how excited we are, everything that's going on in Texas. Will you talk a little bit about why are we in Texas? What are you guys seeing there? Why did you guys get to Texas? What does Texas look like it's going to be doing for us, meaning us as buyers, over the next few years? And then we're going to go to Tyler and Preston. And these guys, I'm telling you, everybody, do not go anywhere. When you see the kind of research that these guys are doing every single day to find properties that will literally crush it for our clients, it is going to blow your mind. And so I can't wait for everybody to see that. So Gary, take it away. Let's talk Texas. And then I want to go to Preston and Tyler and talk a little bit about what is that process. And here's a little teaser. We've developed with our partners an AI that is assisting with the research process and the rent finding process. And Tyler Tyler and Preston are going to talk a little bit about it. It is so cool. You guys don't want to miss it. But Gary, let's talk Texas. Everything's bigger in Texas, right?
Yes, sir. You asked why Texas? Well, I weigh 300 pounds. I'm big. I need to go to Texas. Okay, turn it over to Tyler and Preston. I'm done.
That's all you had.
Yeah. That's all I have. No, I don't weigh 300 pounds, but a long time ago I used to. So, 2.5 years ago, Steve Earle reached out to me, January of 2021. And he had said, hey, you know what? You love us. We love you. You've referred hundreds of clients that have bought hundreds and hundreds of homes. We need more markets for our clients. And, we thought maybe Idaho would be a good one because that's where I lived at the time. And I told Steve, you know what? I would love nothing more than to work with you guys again. But Idaho sucks because I love Idaho, but the properties are just too expensive and they will not fit your program. So we sent a few down, and Steve was like, yeah, sure enough, that won't work. Because, even 3 years ago, Idaho Falls typical 3-bedroom, 2-bath homes were 400 grand, and they just didn't fit your model. And so I said, I'd happily go. I'll take Preston with me, and we'll go find a great market to work with you guys. And we went on our journey of discovery, and Texas was right on our list back then, 2.5 years ago. Because everyone I've ever talked to, and a lot of your clients say the same thing. When are you guys going to be in Texas? Why aren't we in Texas? Texas real estate is the place to be. And there's a big stamp on Texas real estate should be something we play in. And I had felt that for a long time. So 2.5 years ago, Preston and I, we actually did a lot of research online, a ton of research looking at various cities, not just in Texas, but across the country, 20 different markets. And we went on a 10-day trip, me and Preston, because we really were honing in on Texas and Oklahoma. And part of that process was the gut and feel that Texas has so much opportunity. But literally, when we got to Dallas, we drove to Dallas, we drove to Houston, we went to all the suburbs. We spent 10 days doing this, and we couldn't wrap our mind around how big it was and how amazing it could be. Yet we found at the time, not selfishly, but selfish for the company, DFY, that, man, if we just went to Oklahoma City, we can nail that one now. And we did that 2 years ago. We opened up Oklahoma City, and it was a market that was a million people. We can understand it. It was big enough that there was plenty of opportunity. And I was still thinking Texas is where we really need to be, but I don't understand that metro yet. It's 7 million people live just in Dallas, Fort Worth metro. That is huge. And so we've been looking at it and playing with it for two years. And a year ago, we were rocking it out in Oklahoma City. And about this time last year, Preston and I and Steve were talking, and we're like, we really need to take a closer look at the Dallas market. We need to do the research to get ourselves in there and to get the tentacles in and find it. But just how can we? There's so much there, and it's enormous. And I don't try to understate it. It's just freaking huge. And the good thing about Texas is, even though there's 7.5 million people live in the Dallas-Fort Worth market, in that area, there's still so much open space. And you know what they do in Texas? It's flat. So when they fill the space, they just make it bigger, and they make the circle bigger and the circle bigger and the circle bigger, to where really you just are growing. Now, I want to share one thing with you. Let me just see if I can't do my screen share real quick. I think I can. Let's see here. Go. Man, I had this all done easier. No, that's not it. That's not it.
We're seeing it.
Hang on. You're seeing it?
I'm seeing a text from me. Yeah.
Yeah, I don't want to see that. What about that? Are you seeing that?
I'm still just seeing a text from me.
Okay. Well, that was us trying to get on the webinar. So yeah. I'll stop that share. I'll do another share, because I had it set up, but hang on, it's just an article. I'll tell you what, rather than me sharing that article, I'm just going to look at it and I'll talk to you. You see me again now, right?
Yeah.
Okay. So I just wanted to make sure, it's just a screenshot from an article about Dallas, the metro area, from the U.S. Census Bureau. The U.S. Census Bureau, and this is this year. This was a few months ago. The Dallas-Fort Worth market has a population of over 7 million people, but the 10-year growth rate in just Dallas-Fort Worth has been 20% a year for 10 years. That's insane. From 2021 to 2022, 170,396 people moved to Dallas-Fort Worth market. 170,000 people in 1 year moved to Dallas-Fort Worth. So just so you know, U.S. Census data, a city that is 150,000 people or bigger is considered an MSA. An MSA is a metropolitan statistic area. And MSAs, when you become an MSA, that's when people notice you, like the Targets and the Walmarts and the Costcos. They're like, this community is big enough to bring our services to, and it exponentially helps explode. Well, Dallas-Fort Worth is getting an MSA every year in incoming growth, in incoming population. McKinney, Texas, which is a suburb, is now 500,000 people. And 10 years ago, it was literally about 50,000 people. And so it's just insane with what's going on. The reason we couldn't really grasp it and run with it 2.5 years ago, I didn't understand it. I couldn't, in good conscience, go in there and start nailing homes down to say, here, DFY, here's a great home for a great client. But I could understand it in a market of 1 million people. Now, 2.5 years later, I can understand it in a market of 7 million people. And that's why we have Preston here and Tyler here. And I just wanted to, the reason I bring this up is Texas is a market that is continuing to grow and grow. In the last 10 years, and Preston and Tyler might touch on this, Tyler's the one that discovered this, about their appreciation on the real estate market there over the last 10 years too, which is why this is a great market for appreciation. I'll let them kind of talk to that. But the thing we are with Texas and the Dallas-Fort Worth particular market is we just see it as, well, number one, if you look at Dallas-Fort Worth, another statistic that blows my mind, it's bigger than 38 states population in America. If you take Utah, 3.5 million people, Dallas-Fort Worth is double the size of Utah. The Dallas-Fort Worth population is bigger than 38 states in the United States, just that metropolitan area. And so there's opportunity there. But the thing is, we can't just go find a house anywhere. We've got to be very structural and very rudimentary on how we search this out. And this is why Preston and Tyler, and I'll just toot their horn, but I know they each spend at least 3 hours a day only filtering properties, not the filtering properties that they could get approved for your clients to buy for DFY. And so I just kind of, unless you have any questions with the Texas, we can turn the time over to Preston and Tyler. Kev.
No, that's awesome. And that's kind of what I wanted everybody to hear, is that the opportunity in Texas is so massive just from a population growth standpoint. And that's why Preston and Tyler, you guys are spending so much time sorting through and sifting properties to find properties that will be a good fit for DFY clients. So I think it would be just fascinating for everybody to hear from you guys. What does that process look like? Talk us through kind of what you're going through, what the sifting process looks like, a little bit of how the AI comes into play as we're sorting through properties. I just think it's really amazing for everybody to hear the level of expertise that you guys have and the time that it takes to sort through and find properties.
Yeah, absolutely. Can you guys hear me?
Yeah.
Okay, perfect. Yes. Every day is very extensive on the property searching. And yeah, like Gary said, we came from Oklahoma. My Oklahoma searching process was much easier compared to what I deal with in Texas. I could knock out everything I needed to look through the properties that are new on the MLS very quickly in Oklahoma. And Texas is, I mean, everything's bigger in Texas. That's the saying is there for a reason. It is extensive, which is great because there's tons of opportunity. Tyler and I spend hours every day searching through the MLS, and just one day on the MLS in the entire DFW metro area is hundreds of properties that we have to just sit through. And we work hand in hand with Specialized Property Management, which is Done For You's property management partner on the ground. We are working with them every day, and they are phenomenal. And they have a rent finder AI that assists us, which is, it's amazing. It helps us so much. It takes us a lot of time, but it is really super beneficial. When we're searching on the MLS, we submit the property address into the rent finder AI, and it will spit back at us the estimated rent, all the info on the property, a percentage on how likely it thinks it's going to acquire this rent. Will be like, this is 93% likely to acquire $2,000 in rent. It is really great. And then of those properties, the ones that are like, we get one that's $2,200 in rent, we're like, okay, this is a good one. We then send directly to the guys at Specialized Property Management, like, hey, this is the rent figure we got on this property. Can you confirm it for us? Is this good to go? And they will either say yes or no. But we are doing this with hundreds of properties. And with tons of rejection, we are faced with literally hundreds of properties worth of rejection, which is great for the investors because those are all the properties that we are going through that you don't have to see or deal with because we already did it for you. So anytime a property goes to your inbox from me, Tyler, or Gary, it has been handed through not just my hands, not just specialized property management hands, but also done for you's property analysis team, which we then send the property to. It goes through everybody before it gets to your email inbox. And you can just be rest assured that any property that you get is going to be done for you, approved, and it's awesome.
Yeah, just to emphasize what Preston said, we like to say that we're making data-driven decisions on every single property that we send. These aren't, we're not just throwing darts at a dartboard here. You know, we have all these processes, all these systems, all this data that we are able to go through, review, cross-reference to ensure that every single property that makes it to your inbox has been thoroughly vetted and checked to ensure that it's a phenomenal investment.
That's awesome. You guys, it's so cool and it's so fascinating. We're so excited to be open in Texas. Preston and Tyler, the work you guys are doing is amazing. Gary, same with you. We are so thrilled to be in Texas. So we're going to wrap the webinar for today, but here's what I want to, if you're watching, here's what I want to, number one, we'll hang out. If you have questions, feel free to ask questions. I think the chat's working. I think I got that enabled, but you could also go into the Q&As. You can ask questions. We're going to hang out for a little bit. But in addition, you are likely, if you are currently a done-for-you real estate property owner, you are likely going to be hearing from your coach over the next couple days. There are a handful of things in a number of markets that are increasing cash flows and decreasing expenses right now. And I know these guys, they keep coming in and they are wanting to be able to communicate directly with you. So look out for that. If you are a DFY real estate owner, you are likely going to be getting some communication from your coach because they have likely already gone through and identified something that may decrease expenses or increase cash flow or both right away. So look out for that. If you're interested in Texas, give us a call, shoot us an email. Let's get you in front of some Texas properties. Let's get you pre-approved to make sure that you're good to go. But we hope that this was beneficial and helpful so that you can see the way we're viewing the market. You know, the last thing that I'll say, Steve, we kind of acknowledged this yesterday. We have been looking at the market, at the real estate market across multiple states every single day for 15 years or more. You've probably been doing it for 20 years. And there is a certain level of expertise and knowledge that comes when you then team it with an exceptional team like the one you've heard from here today, that we can honestly stand here and tell you now is not just an okay time to buy. It may be one of the best times in our history to buy, even though you may look at it and say, I'm not too sure. We are here to tell you, we are happy to jump on a call, get with your coach. We will spend time with you. There is so much opportunity right now. And we just don't want you to be sidelined by some of the uncertainty that's in the media and that's out there because there's so many options and so much potential. So we're going to wrap the official part of the webinar right now, and we're going to hang out. And thank you everybody for joining us and for hanging out.
Kevin,
we appreciate you. Yeah,
Mr. Kevin, can I add one thing real quick?
Please.
I know you're wrapping up and we're short on time. I just wanted to touch base regarding the appreciation and why is Dallas designated as an appreciation market? And this is an important thing. I can't believe we didn't really touch on it. But Tyler and Preston were part of the efforts of discovering this. But the Dallas-Fort Worth area over the last 10 years has been growing at a 10% rate in appreciation on an average over a 10-year period. That is well and above the national average, well and above anything that's done for you as experience on a national, on any of your other markets. The reason why we see this as something that's going to continue is the sheer fact of the people that are coming to Texas. It's a red state and people are, and maybe it's politically involved or what, but blue is fleeing to red states, and Texas is a big red state that's attractive. And there is just an opportunity for your home to grow and appreciate at an accelerated rate versus other markets that DFY is in my opinion, Preston's opinion, I think even yours and Steve's opinion. And I just really want to emphasize that is why we're excited. It's also part of why we had to take our time to get here right, to do it right, because there's just so much here home wise, that we just can't go find a home that makes sense because the numbers work. It's got to make sense because it's an investment that works, not just numbers, but what about the location? What about the town? What about the school district? What about the roads behind it and in front of it? All that stuff, and the power lines. And we have to look at all that stuff and make sure it's in a good area where people want to live, rent, and raise their families. And so it's just an added bonus that the appreciation can be, in my opinion, well higher than what